warm welcome to this very special show on ET Now. As we step into the new year and try to put what was hopefully the worst of the pandemic behind us, we at ET Now are delighted to bring our viewers an interaction with Dr. Raghuram Rajan, former Governor, Reserve Bank of India, presently Professor of Finance at the University of Chicago Booth School of Business. Prior to taking over as RBI Governor, Dr. Rajan served as Chief Economic Advisor, Government of India, and also as Chief Economist, International Monetary Fund. So he brings to the table a rare blend of domestic and international experience and across both the fiscal and the monetary policy spheres. Welcome to the show, Dr. Rajan.
Thank you for having me.
It's almost a year to the day we spoke in January 2021. And though the pandemic has not entirely disappeared, we've seen a sea change in the state of the global economy, India included. At the beginning of 2021, global growth had contracted 3.5%, and India was expected to contract 7.5%. Of course, we ended the year a little bit better at 7.3%, but now in Jan 2022, things are very different. The global economy is estimated to have grown at 6% in 2021, while India is expected to grow at 9.2%. So let me begin by asking you, how do you see global growth in 2022? Will the recovery continue, or will it peter out in the face of Omicron? We'll come to India later, but for now, your view of the global economy, Raghu.
Well, I think the global economy is buoyed by a substantial reservoir of demand. So notwithstanding the Omicron virus and the devastation it is already causing, I think there will be a slowdown in this quarter's activity, but it'll get pushed a little further. That said, I would resist the temptation to say we've seen the worst, the virus is behind us. This virus is ever morphing. As you know, when we talked in early last year, we didn't imagine the extent to which Delta would be vicious. And of course, Omicron there could be variants which are far more deadly than this one. So, I think we should have a cautious optimism that there is globally sufficient sort of pent-up demand, reservoirs of stimulus, that the economy will still grow quite substantially, the global economy next year, or this year, I should say. But we still have to be careful in making too many strong predictions given the ever-morphing virus.
Oh, absolutely. In fact, you're entirely right. In Jan 2021, when we spoke, nobody knew what it was, just 2 or 3 months down the line. But coming specifically to the US economy, with inflation now touching a 40-year high in the US, the Federal Reserve has been accused of being behind the curve on inflation and has now indicated a much faster end to its easy monetary policy. How will this impact the global economy and EMEs like India in particular?
Well, the Federal Reserve is the most important central bank in the world. And clearly, a lot of what it does is driven not so much by global conditions, but by US conditions. That said, inflation in Europe is also reasonably high. It's in 5%, for example, in Germany. So there are concerns about inflation in the other big central bank, the ECB. I think you see across emerging markets, inflation is picking up. So if the Fed moves, and it certainly has indicated its desire to move starting March, it is not going to be sort of out of the ordinary for the world. Inflation has been picking up quite strongly. Now, some of this is transient, even though the Fed has retired that term, in the sense that it comes from the coronavirus linked supply disruptions. But there's something far more deeper, stronger in there. If you look at energy prices have been moving up. Some of that has to do with long-term underinvestment in oil, in some aspects of natural gas. And that is coming to hit us now because now the global economy is recovering. There's much more demand for energy. It's an important issue for India because it's such a part of our consumption basket. The other thing which has longer legs is certainly house prices. They've been on a tear and they show up in inflation over time only. But the biggest source of concern has to be the labor market because that's where inflationary expectations get embedded and then get pushed forward. And what you're seeing is perhaps some of the tightest labor conditions that the US has seen for a long, long time. Even though earlier it was at 3.5% unemployment, now it's at 3.9. So there's still, theoretically some room to go. But you talk to employers across the board, they just find it impossible to find workers. And part of the reason is that the unemployed workers are not where the jobs are. So New York City has unemployment of 9% because many restaurants are still closed. Many of the service industry has still not come back fully. But on the other hand, in any manufacturing city, you ask and you find people are willing to hire anybody who walks off the street who passes a drug test, but it's just impossible to find workers. So what we're seeing is a red hot labor market with wages going up at the lower end, but it is translating to higher wages across the board. And if this gets entrenched, no matter whether the cause was supply constraints or stimulus demand, it gets a momentum of its own. Wage pushing inflation becomes a problem, and this is something the Fed is really worried about, that it should not become entrenched. And that's why it's been started making very loud noises, not just about raising interest rates. What was interesting about the minutes that came out a few days ago is they're also talking about pulling back the size of the balance sheet. And that's an interesting new development. They want to actually shrink, which means that there could be effects on both liquidity as well as long-term interest rates in the US, which again feeds into the rest of the world.
Look, there's been a lot of brave talk in India that thanks to our huge forex kitty, now close to 635 billion, that's going to give us protection against the fallout of Fed's action. But as someone who lived through the taper tantrums of 2008, 2009, can any emerging market really take comfort, be immune from the fallout of Fed actions?
The quick answer is no. It gives us a buffer, no doubt, and we should be comfortable that that buffer is a good one. But at the same time, that doesn't absolve us from getting all our other macroeconomic indicators in place. So as you know, for example, the current account deficit has been expanding. We're seeing gold purchases again becoming a bigger part. Oil, of course, is an important component. And the surging demand in the country is certainly increasing imports. Yes, our exports have done well, but our current account deficit is expanding. So that's a cause for some amount of not so much concern, but attention. We should pay attention to it. It's not yet at the point where we have to be overly concerned, but certainly we shouldn't ignore it. At the same time, I think the inflation in the country is something to keep track of. As you know, a number of emerging markets already have started raising interest rates. Brazil, for example, has been doing it for quite some time, partly because of the higher inflation in those countries. We also have an enormous amount of liquidity out there, and that's something to also think about. The broader point is that markets are interconnected. As interest rates move up in the US, they will start moving up in the rest of the world. And to some extent, we should be prepared for that. That will create, some difficulties in financing that were not there in the past when interest rates were lower.
Let me turn specifically to India's growth story. Advanced estimates for 21-22 suggest the Indian economy is back to where it was for the pre-pandemic years, with growth projected to grow at 9.2 this fiscal. However, many experts, including your predecessor at the Reserve Bank of India, Dr. Subba Rao, argue that what we are going in for is a two-speed recovery, a K-shaped recovery, with those in the bottom of the pyramid, such as those in the informal sector workers, yet to recover much lost ground. Would you agree? And what are the dangers of a K-shaped recovery?
Well, I think there are bright spots and dark spots in the Indian economy. And I think we should be aware of both. It's wrong to be overly pessimistic. It's wrong to be excessively optimistic. On the optimistic side, because of these tremendous global demand, I think any exporting industry is starting to do really well. And of course, the IT industry is going gangbusters at this point. I spoke with an IT CEO the other day who said it's just impossible to find workers in India today. So same phenomenon as in the US. So that's benefiting from global demand. Also, maybe some larger companies have paid down their debts. They're showing high profits. They're now focusing more on automation. That's also increasing demand for IT in the country. So that's one side of it. And take also any kind of industry targeting the rich, Asian Paints, people like that. They're doing very well because there is a lot of pent-up demand. The upper middle class in service jobs have been able to continue working during the pandemic without stop. And so things are going quite well for that sector. On the other hand, take the lower middle class, take those in service, high contact service industries, etc., and they've had a very, very rough time. And the numbers, for example, the fact that agriculture has increased employment from 36% of the labor force to 39%. I mean, no growing country increases employment in agriculture. You want to keep bringing down employment in agriculture. And that's saying we have a real problem with the lower end jobs, that if people find going back to agriculture better than staying in the cities and doing those jobs because they've disappeared or they've shrunk, it is an enormous source of concern. And so what I think you have to worry about is that the lower middle class has been deeply affected. And of course, there are all these numbers floating around, how many have slipped from middle to lower middle, from lower middle to poverty, and any of those numbers are really alarming. They're all crude because we don't get at this informal segment of the economy. We don't measure it properly, but any numbers there are quite alarming. And you talk to small and medium enterprises, they are in a fair amount of difficulty. So the bright spot, the big enterprises, the export enterprises, the not so bright spots, in fact, the dark spots, the informal sector, the small and medium enterprises, even agriculture. I mean, if you look at two-wheeler sales, for example, which is propped up, the lower end of the two-wheeler propped up by strong agricultural demand, even that is not showing up as strongly. So we have a real consumption problem. And that's because the lower end, less well-off segments of our population have done really quite badly in this recession. Look at consumption, for example. You said we've got back to where we were in terms of growth, but look at consumption. It fell tremendously last year, and it's come up only by about 6.8% this year. So it's below where it was. And consumption falling while the upper middle class is growing quite strongly means the lower middle class, as well as the poor, have suffered quite substantially. So we ignore this at our peril because it's telling us this is where all the problems start in the economy, but it's also where our future lies, right? So before I end on this dark segment, think of the kids who haven't been in school. Sure. They've been out of school now in some states for 2 years. How do you get them back? And unless you have a pathway for getting them back into school, back into learning, they've actually fallen 3 years behind because they've forgotten a year worth of school, having not been in a proper school since then. And so when you get them back, their parents are going to say, where are you? What are you doing? And they will figure out that these kids are just not keeping up if they brought back into the same class in the same way. And as a result, you're going to see a very high dropout rate, many more girls getting married off, boys put into agricultural jobs, jobs. Our future is at stake if we don't bring these kids back into school in the proper way. And so I think these are some of the things we should be thinking about seriously across the country. It's not one state or it's not a center. It's everyone has to think about this and how to remedy it.
So clearly the recovery and the economy needs more support. So the question is what sort? Monetary, fiscal. Has monetary policy in India reached the dead end in the sense it's a much more broad brush approach? Can fiscal policy be better in these circumstances, but can be more targeted at the groups that really need that help? What is your view?
I will stay off commenting on monetary policy. That's a rule I have certainly in India. I'm happy to, if you want to talk about any other country, I'm happy to talk. But in general, in an environment like this, there's only so much that monetary policy can do. And, you can't push credit. If people are finding it difficult to borrow, if lenders are themselves strapped because of growing exposure to one sector or the other, credit flows are tepid at best, and that's the situation when you look at Indian credit from the banking sector. Yes, there's some other stuff that's coming in, fintechs, NBFCs, and so on, but it's nowhere near enough to substitute for the slower growth. I mean, 6% growth, remember, is nominal growth, when in fact, when you add inflation to our real growth, it's 15, 16, 17%, depending on what index you use. And so we're actually shrinking in terms of credit when you have only 6 or 7% growth in credit. So clearly something needs to be done there, both in increasing the demand for credit, but also increasing the potential supply for it. Some of that involves doing the old homework we still haven't finished, which is cleaning up the banking sector and so on. Monetary policy cannot do very much there. On the fiscal side, I think you mentioned more targeted sort of measures, and I think there is room for fairly targeted measures focused on the urban poor, the urban lower middle class. I mean, one of the realizations during this pandemic was that we don't have much of a safety net for workers in urban areas. And it really is important to think about what kind of safety net. Manrega works in the rural areas. Do we really need people to go back to their villages in order to get Manrega? And Manrega, as you know, is being used in a very, very big way even now, maybe 40% above normal levels of Manrega use. So do we need a urban safety net so as to keep the migrants in the cities, but with some support so that they don't have to go back to their villages every time there is a calamity? It's also important to attract them back to the cities. If they feel that there is no safety net, they're going to be more reluctant while this pandemic is still on. So those are some of the targeted measures that one might think, and they have a long-term staying power also. That urban safety net is something we have to think about and should have been thinking about for some time. So should we put in place some of those? At this point, I think, on the food side, we've largely, targeted everybody who needed grains. Are there other kinds of food? If Omicron lasts for some time, are there other kinds that we need to do? Should we do more cash transfers to the weaker sections of the population? Those are things to think about. I would emphasize that, yes, we don't have unlimited budgets, but that means we have to spend much more carefully, but we should spend in a more targeted way. And it is not for a country of our size and our per capita GDP, it does make sense to take care of the poorest.
Raghu, I know you said that you would not like to comment specifically on India's monetary policy, but there's one question I just cannot resist asking you, that you took over at a very similar juncture when after the 2008 crisis, there'd been excessive, perhaps in hindsight, I agree, monetary policy easing. So is there a sense that the lessons of 2008 have not been learned? Because while the US Fed has accepted that high inflation is not transitory, we in India seem a little reluctant to accept that inflation seems to be fairly deeply entrenched. So is it a sense that it's, we haven't really quite learned the lessons of how easy monetary policy can result in entrenching inflationary expectations?
Look, I'll follow my rule and say I really can't comment on recent monetary policy moves. I'll comment more generally on the idea that yes, inflation gets entrenched over time, and the more it gets entrenched, the harder it is to push back. I think that we have an inflation targeting framework, which I think has served us well in the sense that if we had confronted these kinds of problems during the pandemic without such a framework, perhaps the expectations of fiscal policy and its effect on interest rates would have been much sort of more adverse to us. The notion that the RBI is watching inflation and we keep it under control helps us borrow. at relatively reasonable rates. The fact that the GSEC is still in this 6% range is something that I think is not unconnected to the fact that we have that framework. And so our real rate, the real interest rate in India is pretty much close to zero, which wouldn't have been the case in the past. Now, that said, you cannot get complacent in any country about inflation. And if you have a framework, that framework has to benefit from that you actually believe in it and you're going to implement it. And so we have a framework which is centered around 4%. And I think what the markets over time will look for is that we focus on bringing inflation back to the midpoint. And that's where the expectations should center around.
Well, I hope you're right on that, because I noticed that you use the word that people have the notion that the RBI is keeping a watch on inflation, because increasingly in India, a lot of us are now feeling, is the RBI really keeping a watch on inflation? Because we've been, much above the average, which was like 6.2 was the average last year. This year, we're again inching towards the upper end of the margin. So it's nice to feel that perhaps RBI is watching. But a question
let me just say this, that credibility that has been earned can be spent for some time.
Sure.
But you cannot continue spending it beyond a certain point. You have to earn it back.
Perhaps.
And that's the constant sort of challenge for a central bank. When to spend the credibility that has been earned in the past, and when to get it back because the tijori is empty. And so you have to replenish it.
And the tragedy in all this is very difficult to build up your credibility, and it's very, very easy to lose it. But that's a problem that's a cross that I think all central banks carry. Which brings me to our next question. The US Federal Reserve has really defined its path to normalization. Says first reduction in bond buying, followed by a hike in interest rates, and then shrinking of the balance sheet, as you mentioned. But we haven't really seen any indication from the RBI about what its chosen path should be in the eventuality that as and when it decides to normalize. So what should, though of course, in fairness, they have started doing more of reverse repo auctions, etc. So what is the best path in your mind for normalization? And how critical is it to return to that 25 basis point corridor between repo and reverse repo?
So again, let me not comment on the 25 basis point corridor. That's a more technical issue that the RBI seized off, and that's something they will have to think about. Now, any central bank emerging from a situation of excess liquidity, which is what we have in India today, because the RBI essentially has expanded its balance sheet and is sucking back through reverse repos. Essentially, it's borrowing from the commercial banks to finance its large balance sheet, which then means that the operative policy rate is really the rate at which it's borrowing from the commercial banks, the reverse repo rate. And that is not the historical pattern. Historically, the RBI has focused on the policy rate as the rate at which it lends, that is the repo rate. And so the first thing that it will have to do, as any central bank in a situation of excess liquidity will have to do, is first sort of figure out normalizing the liquidity situation. Now, while it is in the process of normalizing, the policy rate will be the reverse repo rate. And so what that means is if it wants to tighten conditions, it will have to continuously increase the reverse repo rate. At some point, liquidity conditions will become more normalized, in which case the operative rate will switch to the repo rate. And that switch from the reverse repo to the repo rate itself will be a jump in interest rates, because there is, as you said, a space in between the two. So, the RBI will have to manage all this, and normalization will be when the repo rate becomes the operative policy rate. And obviously that will, depending on inflationary conditions, will have to be raised to a point where, it is sufficient to normalize activity and ensure that it doesn't become inflationary. So there is a process by which you first reduce liquidity. In that process of reducing liquidity, you also use the reverse repo as the policy rate, and then you shift towards a normal liquidity situation, even a a deficit liquidity situation. And that's when the repo rate becomes operational.
Yes, indeed. The RBI has a very tough call in its hands. But do full service central banks like the Reserve Bank of India, do they have one more problem? Because some of their objectives, are very often in conflict with one another, which is why there was this talk of setting up a separate public debt office was there. Last year, for instance, was a classic case when the RBI felt obliged to support the government by keeping interest rates low at a time when monetary policy might have dictated some increase in interest rates. So does that become a problem, having conflicting objectives?
I think you're talking about the old issue of whether the RBI should also be the debt manager for the government.
Yes.
In reality, I think in theory it does seem as if those two should be separated, and I don't think the RBI is sort of strongly inclined one way or the other. In practice, what happens is because the expertise doesn't lie with the Ministry of Finance, whatever cell is appointed to actually deal with government debt management almost invariably will use RBI expertise, either as seconded people or people from the RBI advising the government. So the reality really is, do these conflicts of interest play a big part in monetary policy? And my sense is, it really depends to some extent on the frame of thinking of the Monetary Policy Committee. If it wants to think about, government borrowing, etc., and there's so many other things it could think about as being, it may abandon inflation targeting and think about, we need maximum employment. Monetary policy committees can have a mind of their own. The governor can have his or her mind of their own. So, these are ways the two objectives get commingled. But so long as there's a clear sense of direction in the Monetary Policy Committee, I don't think it is, it is a given that that policy will be set to enable the government to borrow.
Except that, Raghu, there is a feeling increasingly in India that the Monetary Policy Committee has not really lived up quite to the mandate with which it was charged under the inflation targeting framework. Because though the Monetary Policy Committee has said, status quo on rates, the RBI through liquidity management has been able to do something that perhaps the MPC didn't quite intend. So how does one get over this kind of a dilemma?
Again, we're getting into territory where I don't want to really comment.
Okay.
I think whatever instruments exist for monetary policy, and I would argue that liquidity is also an instrument of monetary policy. It should be under the purview of the committee that sets monetary policy. That should be a general principle in any central bank. So, it can't be that the instrument that you focus on, say the repo rate, doesn't become operational, so you have really no role anymore. It means that whatever is the operational rate is under your purview.
Yes, there are these issues, I suppose, particularly in a situation where the IT framework is still kind of settling down. But let me now just move to the issue of fintechs, because you spoke earlier also of fintechs. Now, we've seen a dramatic increase in the number of fintechs in India, and that enables faster digitization, which is very welcome. But should central banks worry about the growing interlinkages between fintechs and banks, especially when in the case of some fintechs, they've also got payment bank licenses, and now some of them have also got access to the central bank's lender of last resort facility. So are there any things that central banks should worry about, the growing linkages between fintechs and banks?
I think in India, everything ultimately is connected back to the banks. That's what you discover eventually. So, we had a period when we thought NBFCs are lending, that's great. And then, you realize that the NBFCs borrow from the banks, or who holds the NBFC sort of bonds or deposits that they issue, it's the banks. So everything gets back to the bank balance sheets. And so you have to be a little careful about any risk taking within the system to ensure that it is not unbridled risk taking. Now, with the fintechs, on the positive side, a number of them are using data more intensively, are trying to figure out how to measure creditworthiness in new ways and are being more willing to lend as a result. So that's on the positive side. On the negative side, many of them sort of are overly convinced about technology and don't fully understand borrower behavior. And the ideal would be a marriage between a old style banker and a new style fintech, but those are often hard. Some banks have managed to do it well, but many don't. Now, what you want is the data to be used well, but with the inherent skepticism of a banker saying, yes, but despite all these fine-looking data, maybe the borrower will default in bad times and have to correct for that. So what would be interesting is to see more sort of spillovers in terms of the technology of lending, rather than blind support. You make the loans and I will support you by funding it without any knowledge of what you're doing. That just exposes the banks to risk, but some sharing of activities. The fintech works with the bank understands what the fintech is doing, and over time maybe integrates the fintech's operations into the bank. That would be a good outcome that would make the banks better in lending, but give the fintech some of the bank's abilities. Now, that said, there are always in India also downsides to some of the new operators. Are they collecting money in the right way? Or are they recovering through threats, we had this in the past with foreign banks, we have it with NBFCs. Now there are allegations that some of the fintechs are using sort of strong arm methods to recover some of the money. So, we have to be careful. We have to regulate reasonably. We have to regulate evenly across. There shouldn't be unregulated areas of the financial sector. And we should remember that no area of risk in the financial sector is contained fully. It always expands to envelop the rest of the financial sector. So whatever the area, we have to keep an eye on it and make sure it doesn't get overly big.
Well, another area that I think all of us in India are keeping an eye on, particularly, and is a hot potato at the moment, is cryptocurrencies. What is your view? Is there really a use case for cryptocurrencies, or are they a passing fad? Do they pose a threat to the macroeconomic stability? And how should central banks, respond? Should we in India perhaps have done more to put investors on their guard?
Well, cryptocurrencies come in different flavors, right? So there's the traditional cryptocurrency like Bitcoin. There is the stable coin like Tether and so on. So they're different kinds. Now, some of them are being used for payments. Typically, payments which either are in the crypto world itself to buy crypto assets, or in the past, a lot more was used for illegal payments. And some of it is being used for cross-border hawala, basically to escape capital controls. And of course, in some countries with a terrible currency which is inflating at very high rates, what you're getting is an effective replacement of the domestic currency by a cryptocurrency, not because the authorities want it, but because private people prefer trading in the crypto, Bitcoin or whatever, than trading in the official currency. So there are varieties of uses of that kind. Now, is there a crypto which is used widely in public by people? Not yet. And my sense is, by the time that comes, central banks will have figured out, what a reasonable central bank digital currency will look like, and they will want that to be the main vehicle for transactions. So any crypto has to deal with the possibility that central banks will come in. Now, a lot of crypto mythology is about central banks are inflating away the fiat currency, and therefore this is the last haven, et cetera, et cetera. But at the same time, you see these cryptos fluctuate in value. It's not that they're stable value. You see Bitcoin go up 20%, come down 20%, sometimes, large moves on the same day. So the notion that these are stable forms of payment relative to the fiat currencies, the central bankers cannot be trusted, but this crypto can be trusted, I think that's a small minority of people who think that. Now, so broadly, I'm saying there's no large-scale use case as present. There are niche use cases. Now, what are people betting on? They're betting on, one, crypto becoming a dominant force. That may be the case, but it requires new uses, not the traditional payments for which we have so many. I mean, UPI in India is fantastic. Why would you need an alternative to UPI? Well, maybe a separate rail source to reduce risks in the system, but not so much that the technology doesn't work. So where does the crypto come in? It comes in two forms. One is microtransactions, where you really can't, it's too costly to do the transaction every second, but you can do it with cryptos because it's all automated. So that's one possibility. Not yet a big use. Second possibility is smart contracts. In securities business, I have to deliver a security and I get payment. A smart contract can do it without a third-party involvement. So in many cross-border transactions, when you don't want a third party involved, these smart contracts can work. So there are places they can be used, but you don't see a lot of that used yet. Will there be this killer application, this killer crypto? Possibly. But which one of the 6,000 cryptos will it be? Tether, starts making some claims that it will be that. Who knows? The point I'm trying to make is, for somebody who has limited resources, cryptos are not the safe investment you want to be in. You could lose all your money if you invest in the wrong crypto. You could lose all your money if cryptos become less of a fad than they are, because there's no substantial use case yet. Now, will one of them become, the currency of the future? Perhaps. And certainly central banks will try and give it competition. But we're still far from that. And so it is a very speculative investment.
Okay, so I would in fact have loved to hear your views on central bank digital currencies also. But in the interest of time, let me jump to another issue, which is again attracting a lot of interest in India. There's been a huge clamor from the bond market for inclusion of India in the global bond index. Do you see that as a net positive, or would it increase the short-term flows and hence our vulnerability? Because one of our greatest strengths to date has been the fact that most of our debt is domestically held.
Yeah, I don't have strong views on it. I would like to see more studies. I do worry about what you say, that you become more correlated with international markets and less with the domestic situation. And if you're a big part of the index, that correlation might quite possibly increase. So, unless we have a deep need for external funding, and I think we should, try and keep our current account deficit reasonable so we don't have that. And if we do need that funding, it comes via long-term money, FDI investment in our. I'm not a fan of foreign investment in our unicorns. I think we should have more domestic risk capital invested in them. But I think those are ways that are safer than getting bond flows. Of course, if we have bond flows, I prefer long-term bond flows rather than short-term bond flows. Even though both can be sold instantaneously, at least the guy who buys the long-term suffers a little more of a hit in case interest rates move than the guy who's sort of my deputy governor, Mr. Khan, used to call investment tourists.
That's really the right word, because it has to be linked to our absorptive capacity. But with the budget 22-23 just around the corner, I just have to ask you some questions on the budget. So how do you think government should approach the budget? We've done exceptionally well on the revenue front, surprisingly. So despite the shortfall in disinvestment, because the increase in GDP nominal value, maybe the fiscal deficit is likely to remain within that 6 to 7% range. What kind of deficit should the government target for the next fiscal? A gradual reduction, or should we have a sharp contraction, sharp correction? Should we go slow given the fact that the economy still seems to be in need of support?
I think in all this, the key issue is to maintain the confidence of the markets, of the general public. And that means rolling out a framework. You can't say, this is going to be what we do this year and we'll figure out what we do next year and so on. It has to be if you do want to spend more in a particular year, you have to give a pathway for how you get back on track, a pathway which seems credible. so that the markets have some notion that you aren't going to be profligate. We talked earlier about certain areas which need attention simply because of the K-shape that Dr. Subbarao, whom I respect tremendously, talked about. That said, there's also a need, to some extent, of supporting demand. And I think the clearest and least sort of targeted way is infrastructure, which we need, of course. And infrastructure is done both by the center, but also by the states. And what is important is to ensure that the states are doing what they can there, because that will be important for creating some of the low-end jobs, which are absolutely desperately needed, but also creating demand for domestic steel, for copper, cement, et cetera, et cetera. So I think that it is quite important to have infrastructure well-funded, to have some of these support programs, Manrega, et cetera, well-funded, and to think about targeting the areas that are doing quite badly right now, but need support going forward. I think the other big thing that I would argue for in the budget is a new vision. We are still sort of stuck in trying to make incremental moves, and sometimes in the wrong direction, relative to the vision of the past. But what have we learned from the pandemic? What have we learned about the supply of global services? And my sense is global services offers us a new sort of area where we can expand significantly, relying on our strengths. We already do well in a variety of global services. But what about telemedicine? What about tele-lawyering? What about edutech? These are areas where we need to look at those industries and say, what do those industries need in terms of government support? And it's not funding. It is often better rules. For example, rules on data protection, which meet the standards of the European Union and allow us then to export services to the European Union. These are things we should be thinking about. And in our trade agreements, stop talking about just manufacturing or agriculture. Talk about services, which is our big area. What will it take to expand our services to ensure that a consultant from Bangalore can provide consulting services in Chicago? That's a vision we need. We're still stuck in the past. And that past is getting harder and harder. Manufacturing-led growth, which is what our PLI system, production-linked incentives seems to be focused on, is something that is getting more and more difficult, simply because everybody has woken up to the fact that China was there and what China did, and nobody is going to accept a new China. So, this sense that we're stuck in the past, we need to change that.
I couldn't agree with you more, Raghu, but here, sometimes my sympathies are with the government because we keep hearing this case for more structural reforms. But look at what happened when the government did try to do structural reforms, whether it is farm laws or whether it is labor. So is the government really in a democracy like ours, poor democracy? Is it caught between a rock and a hard place? Because when it acts on the advice of economists and enacts some much needed laws, it's forced to backtrack. So what can one really do?
I think the idea is to be democratic, to talk to people, to bring together sort of the states with the center, and then devise a plan. Now, it's harder. It's much harder. It requires far more action by far more people at the center, which then means expanding the sphere of governance from the PMO to a broader set of people. But if you can do that, there's no reason why you can't bring everybody on board. So my sense is that we can do more. We should do more. Some of it can still be done by the center. Nobody cares about your, laws governing services. That's something the center can do without mass agitation, but it should do it thoughtfully. And similarly, on areas affecting a lot of people, I think talk to more people, get people on board. It is tough. Nobody's minimizing the, but with a government with this kind of power in the ability to enact legislation, I think it behooves it to actually talk to people, and then it can still get it through. but it can get it through after getting more people on board. And that, I think, the lesson from the farm laws is, there may be a lot of good things in it, but if you haven't sold it more widely, and there are some bad things, given what some states want, you have to accommodate the interests. And, it's give and take. And if you can manage that, there is no reason why you cannot move forward. So I think it just requires far more sort of consultation than we have seen. People say we've consulted, eventually we have to do. Yes, but every time you certainly have to show that you are consulting and understand how things have changed in the recent past so that you adopt policy accordingly.
That is true. But as I said, it's always a tough call for governments in countries like India. And I know this is a hypothetical question, but our viewers will be really agog to hear your views. So please don't disappoint them. Also, one of the liberating things about not being in office is that you can take a much more dispassionate view. So if you were to advise a government, whether as chief economic advisor or as Reserve Bank of India governor, what would your 1, 2, 3 priority areas be?
Look, first, they have plenty of good advisors, so they don't need me to give advice. I certainly would not ignore the side of the economy which is doing badly. It's tempting to look at the stock market and say, no problems. But in fact, if you ignore the hurting part, we have longer term problems, as we talked about in terms of education and so on. So you need to worry about that tremendously. I would certainly, if there's a resource constraint, think about enhancing the pace of the asset sales. Not just companies, but also potentially surplus land, etc. Those can be beneficial for the economy and putting them to better use. But those are things that we need to think about. And I would move away from raising tariffs and so on. In fact, we should be thinking about pulling off or bringing down some of what we've done. But that debate, I think, will continue in India. More broadly, I would like to see a vision of what is it that we're trying to do? Where is it that we're trying to go? And my sense is that any kind of vision that emphasizes our strengths will include the fact that we are a democratic country with rule of law, with a judicial system that can go against the government. Those are our strengths and will be the way we build our new economy. So I would like to see an articulation of some of that, rather than a blind aping of the way that China went or some East Asian country went. We are not those countries, and we don't have the ability to go in the direction that they went. The budget, for whatever it's worth, is the central statement by the government. And I think there's a chance for the government to make a statement that shows that it has thought about where we're going and has a sense of how that can be made possible. And clarifies, what our view is on a variety of issues, including foreign investors, including privatization and so on. So I think I would see the budget document not so much as raising tariff A and providing subsidy B, but really a document which says, this is the path I choose over the next 5 years. And every year we update it a little, but that path, that vision seems relatively constant.
Absolutely, Raghu. I couldn't agree with you more. And I do hope the government is listening very carefully to what you said. But I'm afraid we've run out of time completely. So I'll have to end this conversation now, but not without wishing you and all our viewers a very happy Pongal, Makar Sankranti from all of us at TT Now. Thank you so much, Raghu. It's been delightful speaking to you.
Thank you, and same to you.